In the world of investing, there's this constant tug-of-war going on. On one side, you've got the bargain hunters, sifting through the market for hidden gems, and on the other, you have the futurists, betting big on the next world-changing idea. This is the battle between growth and value, and really understanding it is absolutely key to navigating the market.
All right, so here's what we're going to cover. First, we'll break down these two big philosophies. Then, we'll see how the economy makes them trade places for who's on top. We'll ask if the old rules of value are broken, learn how to spot the classic traps in both styles, and finally, we'll open up the playbook for the modern hybrid investor.
So let's dive in. What do these two investing tribes actually believe? And you got to understand, this goes way deeper than just picking different stocks. We're talking about a completely different worldview on what actually makes a company valuable in the first place.
So this is the big question, right? Growth or value? Which side should you be on? Well, the answer isn't as simple as just picking a team. It's really about understanding this fundamental tension between today's reality and tomorrow's promise. And that's the conflict that drives the entire market.
Think of it like this. Value investors are kind of like treasure hunters. They're digging around for companies that the market has unfairly thrown away, convinced that their true worth is just buried under a little bit of dirt. Growth investors, they're the futurists. They're looking through a telescope, focused on a company's incredible potential. And they're totally cool with paying a premium today because they're betting on a massive payoff down the road. Okay, and this is where that philosophy really hits the pavement, where it turns into actual numbers. A value investor spots a low price-to-earnings ratio and immediately thinks, bargain. But a growth investor sees a high PE ratio and thinks, wow, high potential. It's the same data, but as you can see from these metrics, they lead to totally opposite conclusions. It's wild, because what looks like a giant red flag to one investor is a huge green light to another.
But here's the really important part. Neither of these styles stays on top forever. Their performance is basically a seesaw. Leadership swings back and forth, pushed by the powerful winds of the broader economy. And if you look back at history, man, you can see these cycles play out so clearly. The 90s dot-com boom was just a rocket ship for growth stocks, but when it crashed, the value investors got their revenge. Then, after the 2008 crisis, a whole decade of super low interest rates created this massive supercycle for growth, a party that came to a screeching halt when the inflation shock hit in 2022. And if you really want to grasp just how extreme that last cycle was, just look at this number. We're talking about a cumulative return over 700 percentage points higher for growth stocks than value stocks. That's not just a gap, that's a canyon. It was a staggering run that didn't just reshape portfolios, it made a lot of people question everything they thought they knew about investing. So, what's behind these huge swings? Why does this happen? Well, the secret is actually buried inside this little formula. This is how Wall Street figures out what pretty much any asset is worth today based on the cash it's going to generate in the future. Now, the variable you really want to watch is that little r, the discount rate. It's just a fancy term for interest rates.
And here's the crucial difference. Growth companies are what we call long-duration assets. Their big profits are way out in the future. Think of it like a sound that's really far away. The higher the interest rate, the more that distant sound gets muffled, making it seem less valuable right now. Value stocks, on the other hand, are short duration. Their profits are like a sound right next to you, loud and clear. And that is why growth stocks are so much more sensitive to rate hikes. This is the engine that powers that whole economic seesaw.
So after that long, brutal period where value just kept losing, investors started asking this really scary question. Is the entire philosophy of value investing fundamentally broken?
See, for almost a century, investors and academics swore by the value premium. It was this simple, powerful idea that buying cheap, unloved stocks would, over the long haul, reliably beat the market. It was an ironclad rule. But the world after the 2008 financial crisis put that rule to its most severe test in modern history.
I mean, it's the elephant in the room, right? Is value investing dead? In an economy that's dominated by tech giants, whose biggest assets are lines of code, not giant factories, has the game just fundamentally changed for good? Well, the answer might not be that value is dead. It's that we've been using a totally outdated map to find it. Think about it. Our accounting rules were built for an industrial age of factories and machinery. They have no idea how to properly value modern assets like software, a powerful brand, or R&D. So, what do? They often just write them down as worthless on the books.
And bam, look what happens when you actually fix the map. When researchers go in and adjust for these so-called intangible assets, the value premium suddenly roars back to life. This table shows it all. The adjusted strategy doesn't just do better, it shows statistically significant outperformance. So value didn't disappear. It was just hiding in plain sight, obscured by accounting rules that are stuck in the past.
Okay, so even with this new, better map, you're not totally out of the woods. Both of these paths, they're filled with some nasty traps. Whether you're a value hunter or a growth futurist, there are these unique and frankly devastating risks you've got to learn to avoid.
The classic value trap. This is a stock that's cheap for a really, really good reason. Its business is fundamentally broken. It looks like a bargain, but what it really is a melting ice cube. And holding on to one of these will cost you, on average, almost 10% a year in underperformance. Ouch.
But as painful as that is, the growth trap can be even worse. This happens when a high-flying stock, one that's priced for absolute perfection, suddenly stumbles. The story breaks, the dream just evaporates, and because its entire value was based on that promise of the future, there's no floor of hard assets to stop the collapse. The result is just excruciating, an average 13% annual loss.
So how do you actually spot these things before they blow up your portfolio? Well, for value traps, you're looking for clear signs of decay. Is revenue shrinking year after year? Is the company just piling on debt to keep the lights on? Are its margins getting squeezed? These are huge red flags telling you you're looking at a trap, not a treasure.
So, with all these cycles and all these traps, what's an investor supposed to do? What does the modern playbook look like? Well, it's not about picking a side in this war. It's about building a bridge between them.
This brings us to a strategy called GARP. That's growth at a reasonable price. It's really the ultimate hybrid approach. The goal here is simple. Find those awesome, innovative, expanding companies that growth investors love, but apply the strict discipline of a value investor and refuse to overpay. It's about getting the best of both worlds, the upside potential without that nosebleed valuation.
And to steer clear of those traps we talked about, savvy investors apply what are called quality filters. They use tools like the Piotrowski F-score, which is basically a 9-point financial health checklist for a company. Then they look at something called ROIC, or return on invested capital, which is a fancy way of asking, how good is this company at turning $1 of investment into profits? These tools help you sift the real gems from the fakes.
At the end of the day, this whole debate, growth versus value, it all boils down to one simple question you have to ask for every single stock you own. What am I actually paying for here? Am I buying the solid, real-world assets the company has today, or am I buying a beautiful but maybe uncertain promise of tomorrow? There's no single right answer, but just knowing which game you're playing, well, that's the first and most important step to winning.